welcome to the new questions and answers series. In this video I will talk about what is leverage in trading. Is it a necessary evil or a canny Illuminati trap? A lever by definition amplifies the force to provide a greater output force, which is said to provide leverage. In business and finance, it will be a method of purchasing an asset using a debt rather than your own equity. In trading, which we are the most interested in, it is an amount of money your broker is willing to lend you to enter the position size which you desire. How does it work? Let's go through some terms. When you deposit a certain amount of money in your trading account, this money will be called balance. You will be trading some kind of a contract. It can be contract for difference, it will be perpetual, it will be futures, but it's some kind of a contract. You're not physically buying or selling the asset. Whenever you open long or short position, part of your balance will be taken as a collateral by your broker until you close the trade. This collateral is called margin. Equity value will show you the possible balance if you close your position immediately. Whenever you trade futures, perpetual contracts, or whatever you trade, any kind of trade contract, you will borrow money from your broker. You never use your own money. Every time you're entering a position, it's borrowed money. Fee for doing it, it's called funding in cryptocurrency, most commonly known as swap. It is same as your credit card. Whenever you use some money from your credit card, if you give it back before a certain time, you will be charged nothing. But if you exceed this time, bank will charge you for your debt, for maintaining your debt. It is the same with funding and swaps. If your broker says maximum leverage is 500 times, it basically means that he is willing to give you money to enter a position, to lend you money to enter a position 500 times higher than your available balance in your account, which can be pretty useful, but it can lead to huge losses, especially in cryptocurrencies. Why the leverage is useful? First of all, there are markets like Forex which are not so volatile and don't trend too much, where 1 or 2% movement is like 50% movement in Bitcoin. And to make any decent money, you need to either have a really huge account or use the leverage. So to explain things, standard contract size in Forex is described as one lot, which basically means that if you're entering long, one lot long on, let's say, Euro USD trading pair, you will be entering a position sized 100,000 euros traded in USD. Not many people have such an amount of money in their wallets, and even if they do, they want to enter positions, multiple positions, using the deposit they made. They don't want to be locked to only one asset. So if market moves 1% up and you're one lot long on Euro USD, you will gain $1,000. Some brokers offer mini or micro lots, but basically the leverage is really useful, especially in Forex, which doesn't move too much. Also, it makes you trade freely because you can enter multiple positions with the same amount of money. So where is the catch if leverage is so useful? First of all, without understanding basics of risk management, you can run into really big problems. It can be really tempting to think that market will move 1% up, I will gain 100% on my wallet. It's some kind of a magic. It's really tempting, especially for new traders. And I know many of traders want to be a true full-time trader because they see it from this perspective. But remember, when market moves 1% against you and you're using 100 times leverage, you will lose 100% of your account. So it can be a really dangerous tool if you don't know how to operate it. There is also a common misconception of the leverage, especially in cryptocurrency, because of some of the leading cryptocurrency trading exchanges like BitMEX offer something called fixed leverage, which is a total bullshit. First of all, fixed leverage means that you're entering a position with a defined stop loss, and whenever the stop loss will be triggered, you will be not only charged for closing your order, but also you will be charged with a liquidation fee, which is most of the time higher than the normal fee for closing your order. This type of a trading doesn't serve any other purpose than making broker money on the fees. It is only made to for you to lose more money with fees with this broker. Instead of entering such type of a trading, just use cross. I believe it is called like this. Just use cross and define your own stop loss, which is way safer, and especially in losing money because you will be only charged for closing your order. Also, entering position sizes defined only by your best guess because you want to make money fast can lead to really fast draining of your account. Of course, losing money in trading is a part of the business, but controlling the size of a loss can be a difference between making money and blowing up your account. So how to use leverage properly? First of all, enter position size defined by the amount of money you're willing to lose. So whenever your stop loss gets triggered, you should lose not more than certain percentage of your wallet. What is the percentage? It's really personal. Some of the people will enter position sizes which when they will lose 10% of the money. I suggest for fresh traders to stick to 2% or even 1%. So whenever your stop loss gets triggered, you should lose no more than 2% of your wallet size, which means that if you run in a streak of losers, you need 50 losing transactions in a row to blow up your account. Also, forget about getting rich fast scheme. Trading is like running a marathon rather than a sprint. If you are lucky, you can multiply your wallet really fast by over leveraging your positions, oversizing them. But most of the time you will not only, when the luck drains out, you will not only lose all the profits you made, but you will also lose your account. So be aware of it and really think about the position size, think about the money you will be losing if market goes against you. And if this money is too much, you don't feel comfortable with it, just lower your position size instead of moving the stop loss. I hope this video helped you a lot, guys, and I'll see you in the next one. If you want to ask me any questions which I will answer in the videos, feel free to join my Discord and ask them in a special channel designed especially for it. So see you in the next video and trade safe.